The fourth learning objective in Chapter 13 is to report restrictions on retained earnings. Dividends and treasury stock purchases require a cash payment. These outlays leave fewer resources to pay liabilities. A bank may agree to loan a company money only if it maintains a minimum level of equity by limiting both its payment of dividends and its purchases of treasury stock. To ensure that a corporation maintains a minimum level of equity, lenders may restrict the amount of treasury stock a corporation may purchase. The restriction often focuses on the balance of retained earnings. Companies usually report their retained earnings restrictions in notes to the financial statement. Appropriations are retained earnings restrictions recorded by formal journal entries. A corporation may appropriate, that is, they segregate in a separate account a portion of the retained earnings for a specific use. For example, the board of directors may appropriate part of retained earnings for an expansion. Companies can report their stockholders' equity in ways that differ from our examples. They assume that investors understand the details. Note the following points in real-world format. The heading, paid-in capital, does not appear. It is commonly understood that preferred stock, common stock, and additional paid-in capital in excess of par, that would mean, are elements of paid-in capital. For presentation in the financial statements, all additional paid-in capital accounts are combined and reported in a single amount labeled additional paid-in capital. It follows common stock in the real-world format. Retained earnings restrictions and appropriations are rare. Most companies disclose retained earnings restrictions and appropriations in the notes in the financial statements.